Ladies and gentlemen, welcome back. We are live again a little bit later than normal, and this is going to be a shorter live stream than normal. We're going to really target that 30-minute time frame, but there was a lot that happened today. A lot that happened today, and a lot that we should probably talk about for those of you guys that do hop on here. Give some people a minute to get on. Me too, Ergons. Let's go, baby. You guys are showing up. Appreciate you guys. How'd we do today? How'd you guys do? Futures red again. Dan the man, baby. The core group. I knew you guys would show up. There we go. There we go. What does that say? Many factory workers in Shanghai can't get back to work even after COVID controls ease. Tesla, that factory looks cool. Can I apply it? But, yeah, a lot happened today. You had the Fed, which really is pretty interesting. The market sold off this dramatically just because Fed Powell said, a 50 basis point hike possible on the table, whereas if you look at the Fed rate monitor tool, what the markets are pricing in now firmly 3 back-to-back 50 basis point rate hikes. That makes you question, are the markets really expecting this? Like, we're expecting it, but are the markets fully understanding that this is the reality that we are going to be facing as far as the Fed? So it's a weird place to be. Weird place to be in the markets. I've kind of had my suspicions, though, and I voiced that a couple times here on this channel, that even though the federal funds rate monitor tool, Bloomberg, everywhere else is pricing in back-to-back 50 basis point rate hikes, are the markets really expecting that? And I think we kind of got confirmation with the move we've seen today, as well as the move we are seeing in futures, that it's really not expected, and it's coming as a knee-jerk reaction that is not good. We're also getting some alarming data coming out from Corsair. Corsair just put out a basically like an early release, like preliminary earnings data. Their earnings are not for like another month or 3-ish weeks. And they're coming in like 25-30% below the revenue expectation. So that could be bad for NVIDIA, could be bad for AMD. I personally have Corsair products. So, yeah, less Corsair products, potentially less gaming products that are sold, computing things as well. So NVIDIA is a decent part of the S&P 500, I believe like 1 or 2%. So that could be pretty big if those earnings are bad. One that's held up decently well over this sell-off, we'll call it that. And then you also did have Snapchat earnings, which Snapchat is a weird stock in the regards of it usually moves, like its average move is over 20% on earnings as far as the past years. Average 20%. Last earnings, it moved 60%. This earnings, it instantly fell to $22.70 per share. Literally down like 26% in this 1 minute candle, and then rebounded all of that, went up like 8 or 9%, came straight back down to negative, and then you're pretty much at neutral right now. But what Snapchat said was, heading into the future, the budgets from advertisers, which is basically anybody that owns a business, will likely be kind of in a weird moment given the Ukraine situation. That's what they cited, but they also did say that just consumers are slowing down. They're not spending as much. So a couple alarming signs right there. It really helps to solidify my bearish thesis on Facebook. A lot more. I'm a lot more bearish now on Facebook after Snapchat earnings. And then like an Apple, something that is directly more so consumer discretionary, things you don't really need but you want, like a MacBook, right? You can always go out and get a $300, $400, $500, $600 laptop instead of spending, $2,000 or however much they cost. So, it's definitely not looking so good. Now, I don't want to be like the bearer of bad news here, but simply pointing out what I see. Yeah, as far as earnings for tomorrow, a lot of it, yeah, it's in pre-market. You have Verizon, I believe that's Cleveland Cliffs, American Express, Newmont, SAP, Kimberly-Clark, Regions, HCA Healthcare. Nothing that's very exciting, but you could get the post-earnings moves, right? You'll get the numbers that come out. I usually don't trade pre-market earnings unless they are bank stocks, to be honest with you guys. But they do come out around 9-ish, like pre-market. Sometimes they can be earlier, sometimes they can be like right after the bell opens, but in that time frame. Nothing too crazy though. I mean, American Express, that could be an interesting one. Kimberly-Clark, Cliffs for the commodity trade, and then Verizon. They could all be interesting in their own regards, but really next week is the thing that I am positioning for. We got some free trades that we made free today. The Facebook puts, I'm looking very much forward to Facebook earnings. It's going to be quite interesting, though. Down 20K for the last month. Yeah, it's hard out here for a pimp, man. Pimp. By pimp, I mean stock trader, right? Yeah, it's this is the most difficult market that you will probably experience for the next at least 3 to 5 years. These markets don't happen too often. Even like March of 2020, that was a relatively easy market to trade because it was clear, right? Like it was clear we were going to get shut down. This was going to affect the economy. People were coming out and saying, like Bill Ackman, whole time he had a $2 billion short position on, saying that, hey, everything is going to zero. Hotels will not operate for years. Like you had a clear sentiment that was very, very bearish. And it was easy to trade. I mean, I made a lot of money during that time. It was easy to see that. And I was quite early to that as well. This market is like that to a certain extent, but no direction. It's up, it's down, it's back and forth. The premiums are crazy. Next day, they're not. You got earnings that Snapchat is not moving at all. You got Netflix dropping it in a damn historic 22% drop last earnings, 36% drop this earnings. It's a very hard market to trade. That's why making stuff free is definitely going to be your friend in this market environment. That's exactly what I've been doing. Sometimes you win, sometimes you lose making stuff free, but you keep your money. You keep your initial investment. That's the name of the game. If you can get exposure to a lot of these stocks that could move up or down in like Netflix case, Apple's going to be a big mover in my opinion, Facebook, PayPal, these guys that can move really, really big. Even if you're wrong, you're still not going to risk the farm on it, right? Because you're going to get your money back. Even if you have less exposure, like you see with Netflix, even if you have a little bit of exposure, $50 turned into $2,000, you could do very, very well. Holder of the shares, good to see you, brother. I took a real beating today, but that does not discourage me. I have the faith and know someday my long positions will be green. Oh, yeah. Oh, the long positions are unrivaled right now. Unrivaled. And I'm glad you trade. I am, because you can do very well trading. Even if you lose some, I mean, one good trade, like one Netflix put, one Facebook put last time, likely a Facebook put again this time, you know, can make up for a lot of bad trades. But you just want to be nimble, play things small if you're just like buying contracts, right? My strategy, what I've been doing, buy 5 or 10 contracts the day before earnings, couple days before earnings, and then look to essentially make them free. So one quick example of this that I do want to show you guys is Apple. So Apple, what I did today, this is a very risky trade. So I do not recommend, like, none of this is a recommendation, and I don't suggest that anybody does this. If you don't know what you're doing, if you're just unconfident, if you know, there's a lot of ways you could lose money doing this. But just like that, right? I bought 30 May 6th Apple 130 puts. Now these things have man, the odds of Apple dropping to 130 in the next 3 weeks, 2 full weeks, very unlikely. Some would say just as likely as Netflix dropping 36% after already dropping 22%. It can happen. If Apple gets the growth scare, they are priced at like 28 times earnings. It could get there. So it's not impossible. It's just highly improbable. So I don't want to put a $500 bet on that when it's super unlikely, but I do want to have some exposure, right? So bought 30 options for $16 a piece. Well, these contracts went up to $19 a piece earlier in the day. I could have sold like 23 or 24 of them, got my $500, actually made a couple bucks in profits, and then kept 5 or 6 contracts for free. If it hits, it hits. If it doesn't, I kept my money and I got free contracts. That's the way that I like to do it. But especially right now, like you're seeing with Tesla, like you've seen with Netflix, like you've seen with Snapchat, it doesn't even matter what direction the stock is going in this market environment. As you get closer to earnings, the couple days before earnings, the IV starts to hit the option. So when there's a lot on the line, when companies are dropping like Netflix just dropped, people start to make bets, especially down to the last couple of days before earnings. And these contracts, it would not surprise me to see them go from $16 right now to $25 to $30 the day before Apple reports earnings. That's my plan. My plan, flip out, keep as many contracts for free. Hopefully, if I can keep 10 or 15, that's great. If Apple gets cratered, cool. That's great. These will do very, very well. Goes without saying. If Apple skyrockets the next day, well, Apple reports earnings on the 28th. They report earnings on the 28th. I have an extra day on these. So worst case scenario, they'll probably drop to like $5, and I'll still be able to keep some profits on it. But I don't even care as long as I keep my initial investment. That's the trick in this market, is to protect your capital, but also get exposure at the same time. And this is really the only way to do that, in my personal opinion. We in like swimwear. I need Nico to get on here. IG Nico, are you in the building? I want to talk to you about the debit spread. Actually, I'm gonna send an alert out in the trading group real quick, because they wanted kind of guidance on how to do like a ghetto spread, right? If you have an account less than 25,000, or it's called, the technical term, legging into a vertical spread, where essentially you can buy an option. If it goes up massively like they have been, the pre-earnings trades, and they go up 300-400% in a day, you can take profits, also give yourself some additional room for more profits, but you reduce all the risk on the trade. And that's a very important thing that I do also want to go over. A lot of this video is going to be focused around trading. So if you don't like to make money, if you don't care what's going to happen in the markets, if you're just only for AMC, probably not the live stream for you, just to be perfectly honest. We are going to talk about all of those things. I think today was very important, and I hope you guys understand the significance with AMC. Like, if this didn't show everybody that, like, what I've been saying the last, call it a week, right? AMC stock has been very strong relative. A lot of people just click, they say clickbait. They don't even watch the video, so they don't fully understand. And, I want to make it very clear here in this video that what's going on with AMC. I don't just say things and pull them out of my ass. It's all facts that are brought to you guys in those videos, but it's kind of frustrating sometimes when people don't watch the videos. They just judge it and then don't understand. But nonetheless, who cares about that? Who cares about them haters? Bro, we don't let haters bother us. But it's good. It's good. I love you all. I love you all. You are wanted on the YouTube live, baby. Oh yeah, we are in there. In there like swimwear. Yeah, we'll talk about that in just 1 second. I want to make sure that anybody in the trading group that wants to see how to do that is able to, and I can kind of show everybody precisely how it's done. Yes, Nico, you are wanted. Nico. Hey, Tyler, what do you think about Jay Powell saying he would possibly do the 50 base point hike? Does that all but rule out the hike in May being 75 basis points? Sorry if you already talked about this. No, I didn't talk about the 75 basis point, and that was really never a thought in my mind, right? That would be like a shock and awe type of situation. And think about it like this. The Fed, what is more important than the Fed actually raising rates and reducing liquidity is making the markets think they will. So inflation is not 20%. Without food and energy cost, I would argue, which I know the numbers are botched. I know we're feeling a lot more inflation than that. Go to the grocery store, go do anything, right? It's different. It's different. I get it. But strictly talking about the data here and the Fed, they need to make it seem like inflation will go down. So, restaurants don't say, hey, inflation's high, customers will pay it. They already expect it. We're going to raise prices. Nobody's going to care. That's the problem there, right? So then you get businesses getting in the habit of doing that over and over and over again. So even saying a double rate hike, or the markets right now projecting the next 3 to 5 meetings being double rate hikes is plenty to calm those inflation concerns. I've never really thought that we were going to get a 75 basis point rate hike. That would be like a black swan event. Like the markets couldn't handle it. And if, believe it or not, financial markets are very important to the health of the economy. They are two different things, and they can act very irrational. Stock market was ripping whole time. Businesses were shut down, and businesses were in junk bond credit, junk bond like credit ranges. Like a Ford in 2020 yielded you like 9%. It was priced at a decent chance to go bankrupt. So there was a lot of fear. Stocks just kept ripping. It was because of the Fed. Now, how is the stock market actually important to the real economy? Well, one thing you guys have probably noticed, if you have not already, then you're going to know now, you really haven't seen many IPOs, right? So companies, to fuel growth, what do? You list on a public market. The whole reason to be a publicly traded stock is to raise capital. Believe it or not, issuing stock is the only reason you're really on the stock market. It's much favorable conditions to grow a business in private markets if you have plenty of capital. That's why Elon wants to take Twitter private. Now, in that regard, when you're raising money in a healthy market, when you're going to IPO your stock and it's not going to crater 50% in a day like a lot of these stocks would. You IPO a stock today, that thing would have fell 5 to 10% at least. Nobody wants to do that. So you restrict financial conditions in that way. Newer companies, they have less access to capital. It becomes more expensive overall for us, regular people, for hedge funds, institutional investors, for everybody. Restricts capital across the board. Also, at the same time, if you shock in all the markets with a 75 basis point rate hike, then you're going to seriously be hurting retirement accounts, and possibly for quite a long time. So those are really the big ways that the stock market does affect the real economy. Oh, I thought you met a pimp in Las Vegas with your girls. Nah, I'm man, you think I could pull girls? I look at stock charts all day. I'm a freaking virgin, bro. I don't know what you're talking about. I got a few Verizon puts today, YOLO'd $100 and some cheap stuff. I like YOLOs. But they're terrible for your portfolio. Golden Nuggets, I'm here. Nico is here, baby. We are in there. We're in there. Bro, I need to make 12K like yesterday. You made 12K yesterday? Oh my gosh, bro. That's good. That's good. Damn. There we go. Fubo is taking a massive hit. Fubo is taking a ass whooping. I mean, Fubo, Netflix, they're different, but anything with a subscriber base has taken a hit because of Netflix. Even Shopify or Spotify, right? Spotify. Subscriber base, they've taken a hit. Wouldn't surprise me if Apple also takes a hit off of that. They're more diversified, so they have not taken that hit. But anything subscriber based, like Disney, they dropped 5% after. So it doesn't surprise me Fubo is taking a hit, but if that thing gets any cheaper and they can grow and they can prove themselves, man, just that's going to be a killer trade. Hey, lucky I have 3 girls and 1 boy. I actually wanted a girl first. People are like, you don't want a boy first? I'm like, no, I want a girl. I want a little girl. And then I guess that's what I got. Now I'm probably going to be cursed and only have girls. I don't know. Even with IV, I made money on Snap puts today. Left 2 free rides overnight. That's exactly how to trade it. I did... See, with Snapchat today, it was interesting because Snapchat was actually cheaper the further you went out. Very, very strange. Like Snapchat weeklies or even next week contracts were super expensive for like the break evens here, like 16% break even, $350 for next week. But you go out to May 20th, I believe that's the contract that I have. Go out a little bit more. Where's yeah, you can get a 21. Let's do something comparable. I mean, for $350, you could go out 17.76% to break even, and it costs you $345. So it's actually cheaper to go further out, which rarely ever happens. So that's what I did. I played it both ways. I put like what I put on it, like $300. I think there's going to be a move tomorrow, but okay. So all the guys in the trading group. So a debit spread, it's like this. So essentially you're playing the spread. Now you can go from like the 39 to the 40, or even you could do like the 35 to the 40, right? Like you could do, you could buy a 35, sell a 40. Now, the thing about it is you have to go like further out, right? Because imagine it, when you're buying a call, you're basically agreeing, or you have the right to buy 100 shares at $35 per share. Well, if you sell like a $36 strike, you agree to sell your stock at $36 per share. So you would make $100. Each dollar difference, you make $100. That's why if you bought a $35 call, Snapchat theoretically went to $45, you would make $1,000 on that option, because one option controls 100 shares. And it's cheaper to play it like this. It doesn't always work. Snapchat didn't offer a good risk to reward. I looked at them, but it just wasn't attractive. But how I typically set up debit spreads is at the same time, right? So you'd buy the, you buy like the 35. If you do it on Robinhood just like this, you just switch over to sell. And then you sell the 36. It costs you $25. See, this was a really bad risk to reward because you needed the stock to move, and this is for May 20th, but you need the stock to move 28%, and your max gain was only $100. So it was pretty bad on a risk to reward ratio. But what the most important thing is, and for anybody with a portfolio less than $25,000, not a recommendation, Um, it's simple logic here that this is a much smarter strategy to do. And this is what really helped to get my portfolio above 25K and really protect myself, really de-risk a lot of my my trades. So I'm going to show you guys this with a Facebook put that I still have. It's probably going to do very well. I actually have 2 of them. Oh, thank you. Can you take that, Ling Ling? Yeah, so bought this earlier in the day. Actually bought 5 or 10 of them and sold out. So this is free. This is all technically profits. What I do? Did I do 10? Yeah, I bought 10 Facebook puts earlier for $1,870. I thought I had only bought 5, but Robinhood just does whatever it wants sometimes. And then I sold out 8 of them because they went up, right? Bought them at 187, sold out 8 at 247 for 1976. So I already made money on this trade. I made $106 on that. And I still get to keep this money for free. So this is all technically profits. Now, coming down to Facebook earnings, I'm probably not going to do this, but if I wanted to take profits and not really risk anymore, but leave basically a chance to make more money on the table, what you do, not a recommendation, again, not a recommendation, but this is legging into a vertical spread. This is basically how to day trade, because I did all of this in a day. This is not a swing trade. This is how to day trade with a portfolio less than 25,000. You can only do this with options though. And it's not really a trick, but a lot of people don't know about it. So you got the 160 puts. Now, same thing like a debit spread. It's just doing the first part first and the second part next. What you do is you could sell a 155 put. You could do 2 of those. Robinhood will let you do it because you have the protection on the 160. So now it's instantly a debit spread if I were to do this. But you collect this as a minimum credit. Minimum credit of $640. Now, it's a debit spread. So you keep that money. You limit your potential upside. My potential upside would be $1,000 because $5 difference between 160 155, that's $500. I have 2 contracts, that's $1,000 max profit if Facebook closed under 155 by May 6th. Worst case scenario is that I lose the difference between these two, which the difference after this would be like $93, $97. So I could potentially lose $200 more. That's it. So you got into a trade, you got out, you made money, and you still have potential to make another $1,000. That's the secret to all of this. It's you can day trade, get in, get out, get your initial investment back plus profits, and be safe about it. Keep money on the table. So it's honestly, if I were to only use one strategy to build a basically take a portfolio from like 10K to 25K, it would be this all day, hands down. Because you got to remember, even if you had just done this without making these contracts free like I did, right? You bought it for 187. That's it. It's now trading at 400. I did this today. So, if you only had one contract, you bought this one for 187. It's a decent amount of money to lose for like a $10,000 portfolio. What is that? 1% of the portfolio or almost 2%? You don't want to lose that. So that's what you could literally do is go sell a 155, collect almost 100% in initial profits because you collect the 320, and then you could still make $500 if the stock dropped a lot. If the stock went down 30%, 20%, whatever the break even is, which it's 20%, which could easily happen. I mean, that's not too far out the realm of possibility here. Then you could still make a lot of money, and you protected your portfolio, and you took profits, and you essentially day traded, but you'll never get a PDT flag for it because it's not the same. So if you guys have questions, I would love to answer them because I mean, anything that can help people be more protected and grow their portfolios is definitely a win in my book by what I'm trying to accomplish here. Smash the like. This is free 99 golden nuggets. It really is. I mean, you won't hear anyone else talk about that strategy in that form. Like, I don't know. I've watched videos before where they're like, unlimited day trades, right? But it's not the same. A lot of those videos are bullshit, but it's true. I mean, it's possible. And I used to do it every single day. I mean, if you had looked at my portfolio under 25K, dude, you would scroll on the options section for so long because I would have so many free debit spreads just everywhere. What is the name of that strategy? You could do like, if you wanted to look into it on like YouTube or Google, it would be legging into a vertical spread or a ghetto spread. If you want to learn about it on YouTube, there's one guy that goes over it really, really good on YouTube. But it's as simple as that. You just want to make sure, which I don't know if Robinhood will actually let you. Like, if you have a 160 put, like I do right now, and imagine you bought it for 187 like I did today, it's to 400. You get to the end of the day, you're like, damn, I don't want to gamble all these profits on what direction it's going to move. I want to take profits but make some additional money if I was right? If the stock continues to drop. Now, you don't want to get greedy. Don't get greedy. You cannot do a 165 or closer to the money. It has to be further out the money because your 160 serves as protection. I don't know if Robinhood will actually let you do that. Yeah, that's the bad part. Is that Robinhood will actually let you do that. Now, if you were to do this, you turn it into a credit spread. So what a credit spread is you would collect a little bit more money, but if Facebook did drop, in this case, 18% by earnings, and went under 160, you would owe the $500 difference. So you could turn a winning trade into a losing trade by trying to get greedy. So don't get greedy on that. You want to go to a cheaper contract. If you are selling a contract that is giving you more money than the one you own, you're doing it wrong. That's the only thing that I've seen people get confused of before. And honestly, when I first learned about the strategy myself, which was, like 4 years ago, you really gotta like it sounds stupid, but you gotta sit there and think to yourself, like, think about it like 5 or 10 times before you do it. Like, so I have the 160s. If the stock drops, right, I can buy the share or sell the stock at 160, and then see, it's kind of confusing on the put side, but you have insurance at the 160 because it's closer to the money. And Robinhood will tell you to. Like, if you're paying $4.15 for the right to sell 100 shares of Facebook at 160 per share, if Facebook shares aren't 160 or lower by May 6th, this option will expire worthless. And then if you were to sell the 155, I don't want to do that. It would say you're agreeing to buy 100 shares of Facebook at 155 on or before May 6th. So, but you already agree. I mean, you're selling them for 160. If you bought them for 155, you'd make $500 profit. So, Ling Lang. Okay. It's an OP strategy if you are a gamer. That would be the terminology. So your loss to profit ratio is great. Yeah, I mean, you're getting your investment back plus profits in most cases. You know, I used to, like, I used to do this a little bit different, so I would just go to make free contracts, right? Facebook is not the stock to do that on because the strikes are $5 differences, but something like, huh? Maybe Apple. I think they're pretty close. I guess that's a decent one. Like what I used to do is like I would buy like a 155 Apple put. Not this exact trade because I wouldn't do this exact trade, but I would buy it for 113. I would wait until like the 150 250s went to 113. I wouldn't even wait for profits on the trade. I would go sell it, collect my initial investment back. Now you got a free debit spread. So it's good. So after you sell winning calls and have free rides, sell a put for under call strike. Okay, let me read that again. So after you sell winning calls and have free rides, sell a put for under call strike. No, you could do it for the put or the call side. I was just demonstrating on the one that I own, which is a Facebook put. But you could do it on the call side. You could do it on the put side as well. It's just like you own like you'd want to do it on the whichever side you owned. Like you don't have a call and then you sell a put or whatever, vice versa. It's just on one side. You can't do like a call and a put like at the same time. You could if you had bought a call, you bought a put, and for whatever reason they both went up at the same time, maybe like an IV earnings, pre-earnings move. But typically that's not going to happen like that. But you just want to sell one that is cheaper than the one you have. So the 320, you could go down and sell the 150. The only difference is you'd collect a little bit less up front. Right? Instead, you'd collect, in my case, $482. I bought them for $187, so I would make like $120, $130. But I would have a max profit of $1,000 per contract instead if Facebook fell under 150. I could possibly make $2,000 in these contracts, but I think it's better to get that initial profits, especially if you do have a smaller account. But yeah, I'm going to go ahead and wrap up the live stream so I can get up in the morning. The futures are definitely red across the board. Pretty red. Treasury yields are going back up, so definitely not a good thing overall. Definitely not looking like a strong market tomorrow, but we'll see. Futures are not really a clear sign all the time. Yes, Ling Ling. Yes, my Ling Ling. Yeah, so thank you guys for tuning in.